If you've been trading Forex for any amount of time, chances are you've made a mistake or two. In fact, the truth is that most traders make the same mistakes over and over again. In this video, we're going to break down the top 5 Forex trading mistakes that can destroy your account. More importantly, how to avoid them. Mistake number 1. Over-leveraging. Over-leveraging is one of the most dangerous traps traders fall into, especially beginners who are looking for quick gains. It's tempting to use high leverage to maximize profits, but this can lead to massive losses that wipe out your account. Imagine using 100-to-1 leverage on a trade. It's just a small market movement in the opposite direction can cause your account to get wiped out in an instant. Solution. The key to avoiding over-leveraging is to trade with a leverage ratio that matches your risk tolerance. It is best to keep your leverage ratio low, something like 10-to-1 or even lower, until you gain more experience. This gives you room to breathe and manage your risks properly. Always use stop-loss orders to limit potential damage and keep your position sizes in check. Mistake number 2. Revenge trading. Revenge trading happens when you try to win back money lost in a previous trade. We've all been there, taking a bad trade, feeling frustrated, and jumping into another one to get back what we lost. This often results in poor decision-making, emotional trading, and even bigger losses. Solution. The best way to avoid revenge trading is to step back and take a break after a loss. Emotion-driven decisions are rarely logical, and that's when traders tend to make the most mistakes. Revisit your trading plan, reassess your strategy, and don't trade until your emotions have calmed. It's all about being patient and staying disciplined, no matter what the market is doing. Mistake number 3. Ignoring indicators and market analysis. Some traders think they can get by with gut feelings or guesswork. They may ignore key market indicators, charts, or economic news and simply wing it. This is a surefire way to set yourself up for failure. Indicators like the RSI-MACD, moving averages, are there for a reason. They give you insights into market trends and potential reversals. Solution: always make sure to use a combination of technical and fundamental analysis. The key is to stay informed and use indicators to confirm your trade setups. Don't rely on emotions or guesswork. Take time to read the charts and analyze the market. A successful trader doesn't just react to price movements, they anticipate them with solid analysis. Mistake number 4. Lack of risk management. Risk management is the backbone of any successful trading strategy. A lot of traders dive into the markets without a plan for how much they're willing to lose on each trade. Without clear risk management, you're setting yourself up for inevitable losses. Solution: never risk more than 2% of your trading account on any single trade. This ensures that even a series of losses won't destroy your account. Always use stop-loss orders to protect yourself, and calculate your position size based on the distance to your stop-loss. Trading with proper risk management gives you the ability to survive long-term no matter the market conditions. Mistake number 5. Not having a trading plan. Many traders treat Forex like gambling, jumping from one trade to another without a clear plan. Without a trading plan, it's easy to get caught up in the hype and make impulsive decisions. This often leads to inconsistency and disappointment. Solution: the most important thing you can do as a trader is to create a trading plan and stick to it. Your trading plan should include your goals, risk tolerance, preferred strategies, and daily routines. Set clear rules for entry, exit, and position sizing. With a solid trading plan, you'll have a roadmap to follow and won't be at the mercy of the market's randomness. Conclusion: Forex trading can be a lucrative venture, but it's not without its challenges. By avoiding these common mistakes: over-leveraging, revenge trading, ignoring indicators, poor risk management, and trading without a plan, you can significantly improve your chances of long-term success. The key is discipline, patience, and always learning from your mistakes. Trading isn't about getting rich quick, it's about making smart, calculated decisions and managing your risks. Stick to a solid plan, stay disciplined, and you'll avoid these common pitfalls. Happy trading!